We have new needs now. We need investment. And we have to talk to investors in a different way than we do have on social media. So, to help us on this part of the journey, we have a member of the Jedi Council, Investor Relations. And thank you, Brian. Brian Litten.
It's a very different kind of pitch. If you have a great AI innovation and you're ready to launch your venture, you will find that you often need to get access to capital, but you have to approach the world of investors differently, and you have to develop a very compelling narrative to those investors to engage with them, to get them interested in your offering, and ultimately to bring them along in your journey. So how do you do this? It's important at the outset to understand the investor's perspective. Investors are looking at AI solutions that solve real problems. They're looking for solutions that are scalable, but they also have to have a clear path to a return on investment. Entrepreneurs have to tailor their pitch. Different investors have different risk appetites, and they're looking for different types of investments. So you need to do your research and understand what each individual investor might be looking for. Some may prioritize long-term disruption, while others are looking to may seek to look for early traction and quick exits. So know who you're talking to and tailor your pitch. Um, it's also important not just to talk about the technology. In some of the presentations we had earlier today, we talked about kind of avoiding that and talking about the customer, talking about the patient. Here, in the case of investors, it's important to emphasize the business value, not just the technology. Instead of providing, when you're talking to investors, a deep dive on technology, focus instead on how AI and technology enhance efficiency, how they drive revenue, and how they solve a pressing industry challenge. It's also important to go to investors with an established proof of concept to demonstrate that there's early traction, that there's a promising partnership, that you've had success with an MVP, that your AI is more than just theoretical. It's also important to be really practical about AI and not to overhype capabilities. You need to communicate clearly about AI's limitations, dependencies, and the ethical considerations. So when you're talking to investors, you need to focus on the market need and the problem that you're looking to solve. How does your technology solution solve an urgent pain point in the market? And how are you differentiated from others in the market? What makes your solution unique? Is it proprietary data, better algorithms, domain expertise? And then scaling and monetization. Can your technology scale across different use cases? And what's the revenue model? So you're thinking a lot about beyond the technology into the business considerations and what the investors want to hear about. Regulatory and ethical considerations. Discuss how your compliance, bias mitigation, and data privacy issues are all being managed appropriately and effectively within your domain. Um, think about your team and how you execute. Investors bet on teams. So showcase your AI and business expertise, your track record, and your ability to attract and retain talent. Go-to-market strategy. How will you drive adoption? What partnerships, sales channels, or enterprise adoption models are in place? And use of capital. You need to think about that carefully too. You know you need capital, but be really specific when you're talking to investors about how much capital is needed, how you're going to use that capital, what milestones will be achieved when you deploy the capital, and what are the KPIs you're going to use to measure your progress, and if there's the need to perhaps pivot or adjust what you're doing. And without doubt, there will be occasions when you make a misstep, or maybe you say something to an investor that's not fully accurate, and you realize along the course of the way that you need to make a correction. Own your mistakes. It's not a problem to make mistakes. We're all human. We all make mistakes. If you say something to an investor that is a misstatement, Acknowledge it quickly and correct it confidently. Pivot to your strengths. If a particular claim is weak or challenged, validate the strengths of your business. Engage in dialogue. Investors appreciate a thoughtful discussion. So if you don't have an immediate answer, offer to follow up with data and turn objections into opportunities. A tough question from an investor often signals that that investor has interest in you and what you're doing. Don't be defensive. Show that you're open to constructive feedback and willing to refine your approach. When you're considering your immediate needs for short-term capital, always have your longer-term strategy in mind. So think beyond the first round. Building relationships with investors is just as important as building relationships with your customers. It's an ongoing process. Ensure that there's alignment on vision, on risk tolerance, and value add beyond capital. And think about how you diversify your investor base. There's strategic investors, venture capitalists, private equity, angels, and corporate partners, and they all offer different benefits. So you need to consider which type of investor aligns best with your growth trajectory. And also plan for future rounds early. Fundraising is a continuous, arduous process. Even while executing on your initial round, maintain investor engagement for potential future raises. I like to establish a regular cadence of quarterly meetings with targeted investors to bring them along on the journey of the business. Even if you don't have the immediate need to raise your next round of funds or don't have visibility to raising your next rounds of funds, the relationships that you establish with investors will be really important when those times to raise money do materialize. Think about your exit strategy considerations. Investors, are not putting money indefinitely into your business, so they'll want to know what your thoughts are about the long-term exit, how they'll get their money back, how they'll make a return. Might that be an IPO, acquisition of the business, long-term private growth? But keep those potential end games in mind when choosing investors. Be prepared for AI's evolving landscape. AI regulations, competition, and technology are changing rapidly. So keep investors updated on how you plan to stay on top of this and navigate the shifts. I guess in summary, just remember to approach investors with a clear problem solution fit, focus on business value, be prepared to discuss critical elements, recover from your missteps gracefully, and build a long-term investor strategy. Thanks.
Thank you, Brian. And we've got 30 seconds. Constantly, I know you're not a VC, but healthcare sees itself as an investor, don't they?
Absolutely. And Brian, you touched upon it, which was actually the way that you, the narrative itself, the business narrative that you're presenting, and the variation in the type of investor that you might be pitching it to. Do you have any specific tips on that? Or could you expand on, say, investing to a VC versus a PE fund, which might be a little less interpersonal? So when you're dealing with corporates versus people, and so if you could expand on that.
Yeah, it's a valid point, and I think it goes to the need to understand what the investors are looking for. I don't know, in my experience, that it matters so much that you need to augment your pitch between a VC and a venture capital or a private equity firm, as much as it is doing your research and understanding what the individual investment firm is looking for in investment opportunities. Are they looking for are they only, what size check do they write? Does that correlate to the amount you're looking to raise? If they only write checks for $25 or $30 million and you need $5 million, it's not going to be a good fit. So be aware of that. A lot of investors, whether they're private equity or venture capital, will have thresholds for top line revenue. They won't invest in a company unless it has $3 million of revenue, or at least $10 million of recurring revenue. So know that going into a pitch. Other investors might be looking to see that the business is cash flow positive or has visibility to being profitable. Understand those dynamics too. The most important thing is investing in yourself as an entrepreneur to constantly enhance and hone that pitch. While you're doing your research and you're building a cohort of suitable investors for the stage of the business where it is at that point in time, uh, every time you do a pitch, it should be getting better and better. You should leave that pitch, think about what you said well, what you could have said better, and next time go out of the gate and do it a little bit better. And each time it gets better, it gets sharper, it gets more focused, and you'll have more success. I'm Litten. I am a digital health CEO. Over my career, I have built and exited a number of companies in the digital health space, all with the common theme of leveraging technology to provide higher quality care and better access to care, primarily for vulnerable and neglected populations. Currently, I'm working with a number of investors across North America, helping them with deal flow and helping to provide mentorship and leadership to their portfolio companies. So a lot of experience navigating technology in the investor space, and happy to share some of my insights today.